A company most investors can't name beat OpenAI. First by value, then to the IPO filing. Most people will learn its name the week it prices. By then, the deal is set. Why does that matter? Because the first one to list becomes the yardstick deal. It's the one that sets the price for every AI lab that follows. Here's the headline. At the end of May, Anthropic raised private funding at a $965 billion valuation. Days later, it announced its confidential IPO filing. OpenAI didn't file until a week later. That gap matters more than it looks. Prediction market traders now put Anthropic's odds of listing first at around 74%. So 3 questions sit on the table. Why is Anthropic suddenly ahead? Why is institutional money treating it that way? And what does that tell you about how this entire IPO wave gets priced? Hold those. We'll get to all 3. Hey, welcome to New Stock Signals. I'm Max, the digital twin of Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. Bill personally researches and writes every video script himself. I hope you enjoy. He reads every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. Why should you care which company files first? Because the first major AI listing sets the benchmark. It becomes the yardstick deal. It tells the market what a pure-play AI model company is actually worth in public hands. Every AI stock that follows gets priced against it. This video is for 2 kinds of investors. The one trying to understand the biggest IPO wave in market history, and the one who already knows the numbers and wants to know what the sequencing actually signals. Here's my goal. By the end, you'll understand why Wall Street is leaning toward Anthropic, and you'll have a way to think about it that has nothing to do with which chatbot you like better. Let me step back for a moment. In Renaissance's 3 decades tracking IPOs, we've never seen a rivalry like this one. OpenAI and Anthropic, 2 giants, roughly $1.8 trillion in private value between them, together worth more than every company that went public in 2021 combined. That's the scale. Now the question is which one comes first and what it does to pricing. Think of it like this. When the dot-com era arrived, the loudest name wasn't always the durable one. And the companies that survived weren't the ones with the most attention. They were the ones that turned the technology into real economics. Margins, revenue you could count on, a reason to exist after the noise faded. That's the lens. Fame is not the same as a business, and the market, when real capital is on the line, eventually knows the difference. Here's what really matters. Wall Street isn't pricing Anthropic ahead because of the brand. It's pricing it ahead because of the numbers. Let me give you 3. First, valuation. Anthropic's last private round valued it near $965 billion. OpenAI's most recent mark sat around $852 billion. For the first time, the underdog is worth more than the company that started the whole thing. Second, and this is the one that moves institutional money, revenue growth. Anthropic's annualized revenue run rate has grown roughly 5-fold in under 6 months. That's not a typo, 5-fold. Reporting puts that run rate in the mid-$40 billion range, and the company is reportedly on track for its first operating profit. A profit in a sector that mostly burns cash. Third, the economics gap. Here's the contrast that tells the real story. OpenAI in its most recent quarter reportedly lost about $1.22 for every dollar it earned. Enormous revenue, enormous losses. Anthropic is approaching the same scale of revenue while moving toward break-even. That's the key insight. Big money doesn't reward the biggest story. It rewards the business closest to standing on its own. Anthropic's edge with Wall Street came from coding and enterprise. Its advances in coding and cybersecurity rattled the field, and that's where the paying customers live. Not consumers chasing a free chatbot, businesses signing contracts. Remember the Amazon lesson. In 1997, Amazon wasn't the flashiest internet story. It was a bookstore with better economics than anyone saw coming. The market figured that out slowly, then all at once. Anthropic is building the margins. OpenAI is building the audience. And the one with the margins is the one that gets to set the yardstick. So what changes because of this? And what should you actually do with it? Here's the first shift. Stop ranking AI companies by how often you hear their name. Start ranking them by unit economics. The question isn't who's famous. It's who keeps a dollar of every dollar they bring in. That single reframe will protect you through this entire wave. Second, understand what the first listing does to everything after it. If Anthropic prices first, near or above $1 trillion, that number becomes the yardstick. Every AI company that follows, OpenAI included, gets measured against it. The first deal doesn't just raise money, it sets the rules. Third, and this is the disciplined part, a near $1 trillion debut is not a guaranteed win. Let me be clear about that. Some of the largest IPOs in modern history have underperformed. Some have gone on to compound for years. A giant valuation tells you the company is important. It does not tell you if it's a good stock. Here's how to think differently. 3 mistakes to avoid. 1. Don't confuse the company with the stock. A great business doesn't always mean that the price is right. 2. Don't chase the open. The first days are a tension test, not a verdict. Watch whether institutions step in and hold. 3. Be cautious of the synthetic stuff. There are products claiming to track these valuations. Anthropic itself warned 8 secondary platforms that those transactions aren't authorized. Stop reacting to the headline. Start reading the structure underneath it. That's the whole game. Now let me argue against myself for a minute. Filing first doesn't mean listing first. Fair. A confidential filing is a step, not a guarantee. Markets can shift, pricing can slip. The value of being the yardstick deal can change the sequence. I'm telling you where the evidence points today, not what's certain. Anthropic's valuation went up too fast. Also fair and worth respecting. When paper value runs from 0 to $1 trillion in a few years, fair pricing gets hard. Even the bankers know it. And here's the honest part. Every one of these companies, OpenAI and Anthropic both, is asking public investors to buy in after the private market already captured most of the climb. That's the real risk in this whole wave. Not which one wins, the price you pay to join. I'm not here to tell you to rush into Anthropic. I don't know the public price tag yet, and neither does anyone else. I'm telling you why the smart money is leaning the way it's leaning, and how to keep your head when the listing finally hits. So let's bring it together. The most famous AI company is no longer the most valuable one. Anthropic filed first, it's worth more on paper, and its economics are closer to standing on their own. Wall Street is pricing the business, not the brand. That's the lesson that outlasts this one deal. One deal sets the yardstick. Everything that follows gets measured against it. Now you know why. In a wave this loud, the edge isn't knowing which name is biggest. It's knowing how to read what's underneath it. Most investors will watch through the headlines and get whipsawed by every one of them. The ones who don't will be the ones with a system, a way to separate the business from the story and the price from the prize. If that's the kind of investor you want to be, subscribe and stick around. We break down every major listing in this wave the same way, calmly with the numbers, before the crowd catches up. And if you want the full framework Bill uses to read these deals, his upcoming book, The New AI Stock Edge, is available for pre-order. Link in the description. This isn't about chasing headlines. It's about building a system that works when the noise fades. When the whole market is watching the loudest company, the real opportunity is usually in the one doing the quieter math.